G'day there. If you're ready to get started investing, you were sold on the idea of dollar cost averaging into index funds or exchange traded funds, but right now you are struggling to work out which exchange traded fund should I invest in, then this video is absolutely for you, because in this video I am going to share with you a very simple strategy that I use to filter down the universe of, I think it's about 12,000 exchange traded funds in the world, how to filter that down into a small basket of exchange traded funds that will allow you to invest with absolute confidence and start getting your money working for you. G'day there, my name is Phil McGilvray. I'm a financial coach, financial well-being consultant, and founder of the Money Boss movement, where we make practical, life-changing financial education both understandable and accessible for everyday people. And today we are looking at exchange-traded funds, and more specifically, which exchange-traded fund should I be investing in if I'm just getting started investing? Okay, and before we get started, just a quick disclaimer. I am not a financial advisor. This video is for educational purposes only and should in no way be considered financial advice. So please make sure that you do your own research or speak to your own financial advisor before you get started investing. So there are currently over 12,000 exchange traded funds available around the world, and this number increases every single day. And here in Australia, there are 328 exchange traded products listed on the Australian Stock Exchange. So of course, the big question is, well, how do I choose which one I want to invest in? So today, what I'm going to take you through is, again, the very simple system that I use to identify the exchange traded funds that I want to invest in. And I'm going to do it using the Australian market just as our case study, if you like. But the strategies I'm going to share with you work in any market around the world. So let's get stuck into it. Here is a list of all of the exchange traded products available on the Australian Stock Exchange. So as I said to you, there are 328 exchange traded funds, and they're all divided up into categories. So when we start looking at, well, what do I invest in? What we want to do first is to start eliminating the categories we're not interested in. So rather than getting stuck in the weeds, let's look big picture, high level, and eliminate the categories. Now, down the bottom here, you will see a link. That link is also in the description below this video, where you can go and find the list that I'm about to show you of all the exchange traded products so that you can go through and do this process yourself. Okay, so let's first start eliminating the different groups or different categories that we're not interested in. So the first step in this process, eliminating the categories. So eliminate anything that refers to company size. Second step, now I'm going to go through some more detail. Second step here is remove anything that invests in a specific sector. Step 3, remove an ETF that invests in specific countries or regions. Step 4, remove any exchange traded funds that use the word strategy or try to use strategy to engineer better returns. So let's have a look at what this looks like. So here is our categories of exchange traded funds again. The first thing that we want to do is eliminate any exchange traded fund category that refers to or bases its investing on the company size or value. So that means removing small caps, mid caps, or large caps. So cap being capitalization, i.e. the size of the company. And you can see we have one category there, Australian small and mid cap. We're going to take them out of the equation. And what that does is it reduces our exchange traded funds from 328 to choose from down to 319. And the next step in this process is to remove any exchange traded fund group that refers to specific sectors. So this is where we're trying to get down to the nitty gritty. Which sector in the market is going to perform best in the next year, 2 years, 5 years, 10 years? No one really knows. Every single year it changes. One year it's going to be commodities perform better. The next year it might be cash performs better. The year after that it might be Australian shares perform better. No one really knows which sector is going to perform the best. So trying to pick and choose is a bit of a mug's game. Now a lot of professional fund managers try to do this, but that is why around 80 to 90% of professional fund managers don't actually outperform the index. So we don't want to get stuck in the weeds trying to do this. So what we're going to do is we're going to remove Australian sectors, we're going to remove global sectors, we're going to remove infrastructure, we're going to remove property, both Australian and global, we're going to remove currency, we're going to remove fixed income for Australian dollar, fixed income for global, we're going to remove cash, and we're going to remove commodities. So that's brought our 328 ETFs down to 188 so far. Let's now remove any exchange traded funds that talk about strategy. And this is where you have different financial institutions and professional fund managers. They're trying to use strategy to some kind of strategy to engineer better performance. But history shows that this doesn't actually work, and it does typically increase the fees. So it's a double whammy. You're paying more fees for a result that doesn't generally, over the longer term, outperform in the end. So why include that in your portfolio? So if we remove Australian strategy and if we remove global strategy, that suddenly drops our exchange traded funds down to from 328 to 41 exchange traded funds left to deal with. So all of a sudden it's starting to become a little bit more manageable. Then what we want to do is, you can see we're left with now just 4 categories left to focus on. Australian equity, so Australian shares, global equities, so shares from all around the world, USA shares, and then we've got mixed assets, which is a little bit of everything in there. So let's have a look now at the second process for filtering these out, and I'm going to focus on the Australian equities to show you how this is done. So what we want to do now is we want to eliminate any exchange traded funds with fees over 0.35. Now I have created another video where I talk about the impact of fees on the performance of your portfolio over 10, 20, 30 years. And it is so much more than you can imagine. So you don't want to be paying more in fees than you need to. Step 2 is we're going to eliminate any exchange traded funds that don't track an index. So an index being, let's just say the S&P 500, which is the top 500 shares in the US, or the ASX 200, which is the top 200 shares in Australia, or the Nikkei 225, which is the top 225 shares in Japan. There's all sorts of indexes, and that's what we want to choose, a fund that invests in an index or tracks an index. So we want to eliminate everything that doesn't do that. Step number 3, we want to remove any indexes that only have less than 50 shares in them, because that just narrows the pool a little bit too far and creates more volatility. And then what we want to do is remove anything that focuses on small, medium, or large capitalization companies. So any ETF that focuses on that, we want to remove. So let's have a look at what this looks like. We can see here, step 1, we want to remove any exchange traded funds with fees over 0.35. And when we print off that document that I gave you the link to earlier, it has all the management expense ratios listed there. And so if we tick off anything with over 0.35, I think there's 1 or 2 here. There's 2 there, they immediately get taken out. Oh, sorry, there's 3 there. So we got rid of 3. So we've brought 11 down to 8 now. And then if we go to the next step, we want to remove anything that does not track an index. And you can see in investment style, it's got track, 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 track. So that's telling us that it's following an index. It's basically just replicating an index. We want to remove anything that doesn't do that. And I think there's only 1 in there that doesn't do that. So we're now down to just 7 exchange traded funds. Next step then, eliminate anything that doesn't track or the indexes have less than 50 companies in them. So that takes out a couple there. And then the last step in this process is to remove anything that refers to small cap, mid cap, big cap companies, because we don't want to be picky and choosy. We want indexes that will include everything. So if we have a look at that, we take out that one down the bottom there that's got large cap shares. And that leaves us now with we go here, with just 4 Australian equity funds to choose from. We've got the beta shares, Australian 200. Its code is A200. We've got the iShares Core S&P ASX 200, and we've got the Spider S&P ASX 200 there, and you can see they're all 200s, so basically they're exactly the same shares, the top 200 shares in Australia, and then we've got the Vanguard Australian Shares Index Fund. So any one of those would pretty much do exactly the same thing. Now, if we applied the same 4-step filter system to the US shares, it would also bring 11 exchange-traded funds down to just 4. The iShares Core S&P 500 Australian dollar hedged. So what this means is they take out the fluctuations that occur in currency. You've got the iShares Core S&P 500, you've got the Spider S&P 500 ETF Trust, and then you've got the Vanguard US Total Market Shares Index. Now, you'll notice here that these three here particularly, again, they're the top 500 shares. So you're not going to go too far wrong whichever one of those you choose. So if we use the same 4-step filter system for the global equities, then you can see we're only left with one, and that is the Vanguard MSCI International Index. So this is then, it's got shares from all over the world in it. So it's got Japanese shares and European shares and UK shares and US shares all in the one index. So you don't have to go and try and pick and choose. These guys have already picked those for you by tracking the MSCI index. And the last category we've got is the mixed assets. We've now looked at the Australian equities, we looked at the US equities, looked at the global equities. The last one is mixed assets. And mixed assets is simply just a all-in-one diversified portfolio where it's got a little bit of everything in it. This is a great place to start if you're new to investing and you just want to start building a portfolio, because you don't need to think about, well, how much of each of the different things, how much Australian equities or how much bonds or how much US equity. You don't need to worry about any of that. It's all done for you in one portfolio. And this is a great place to start. This is how I started my kids with a diversified portfolio. So if we look at what that 4-step filter system did in terms of the mixed assets, what we're left with is 5 exchange-traded funds. We've got the Beta Shares Diversified All Growth ETF. We then got 4 Vanguard funds. Now, these funds are basically the same in terms of the different constituents. It's just how much of each we've got in the portfolio. So we've got the Vanguard Diversified Balanced Index Fund. We've got the Conservative Index Fund, we've got the Growth Index Fund, and we've got the High Growth Index Fund. And what happens there is that each one is just a little bit more assertive in terms of how it's invested. So if you're a very conservative person, you might go, look, I'm worried about all the fluctuations, so I'm going to invest in a Vanguard conservative diversified portfolio, which means that most of it will be invested in things like bonds and fixed interest and cash, and just a little bit will be invested in Australian shares and global shares and small company shares and so on. It will just mean that there's less volatility over time. If, however, you're young and you don't, you're not going to touch this for the next 10, 20, 30 years, you go, it doesn't matter what happens in the short term, then you might want to go a high growth exchange traded fund, because you go, right, I'm not going to touch this. It doesn't matter if it goes down in the short term because I'm just going to keep investing all through the cycles. And in this fund, it would have most of the money, and I'm going to show you in just a moment, most of the money in Australian shares and international shares and small company shares, and perhaps 90% of the portfolio will be in volatile assets that ultimately give you a better return over the longer term. So if we have a look at a quick example here, this is the Vanguard Diversified High Growth Fund. And you can see that it's got 34% of its funds, 34% of the funds are in Australian shares, 25% is in international shares, 14% is in international hedged, so just taking out the volatility that's created by currency movements. We've got 6% in global bonds, we've got 6% in small companies, and so on. Now, if we move over to the right-hand side here, we've got diversified balanced. So 90% of the funds in a diversified high growth fund would be invested in things like shares. Whereas if we go to the diversified fund, you can see the top thing on the list here is 33% of the funds actually end up in a bond index. which is considered a fairly safe type of investment. So most of the money is there. Then we've got some in Vanguard shares. So all the same shares, all the same indexes are in both. It's just the percentage that goes into them based on your risk profile. Okay, so I hope that makes sense. If you're looking at starting investing, certainly using a diversified fund is a really good way to get started because it takes a lot of the risk, a lot of the decision out of it. And if you just need to get started, you need to make a decision, then one of these is probably a really good idea for you. Okay, so I want to finish now with some advice from Warren Buffett, who is by far the smartest investor in the world. And he says his advice for small investors is to put their dough into an index tracking fund because of their broad diversification and low costs. So this is exactly what we've narrowed your pool down is to low cost index funds that will allow you to just get started investing, allow you to dollar cost average into it without really worrying about it too much. And as long as you've got a 7 to 10 year time frame, then ultimately we do see markets and investments head up over those kinds of time frames. Also, Warren Buffett has said here, and this is worth noting, a very low cost index fund is going to beat a majority of amateur managed money or professionally managed money. So this means that you don't have to be an expert to actually outperform. All you need to do is to dollar cost average into index funds, and ultimately you're going to beat most other people, and certainly you're going to beat most of the other professional fund managers as well. So do not overthink this. This is really important. I have created another video. You can see there's a link above here that is on dollar cost averaging. If you're not sure what that is, please click on the link and have a check that out. I've also put a link in the description to that. Check that out because it is by far the simplest and easiest investment strategy out there to get started. It's a very powerful investment strategy, so make sure that you have a look at that. Okay, if this has been helpful, please click the like button because that helps my channel reach more people. And please also subscribe because every week I release more videos with practical life-changing financial education, simple systems and strategies that will literally make a $1 million difference to your future if you take action. So click the like, click the subscribe, and I will see you in the next video.